We are live.
Okay, perfect. I will monitor that. And if we have, it looks like 2 more people are waiting. Okay.
I'm ready.
Well, okay, we can go ahead and get started.
Okay. All right. Welcome everyone to Alpha Kappa Alpha Sororities Omega Lambda Omega's first part series of the financial literacy. We have 3 more parts coming up, and we're really excited that you're here. My name is Felicia Lowry Herndon, and I'm the president of Omega Lambda Omega. Welcome. Sorashima.
All right, I was multitasking, trying to get on Facebook. Good evening, everyone. Thank you so much for joining us this evening and caring enough about your wealth and your family's wealth to learn about financial literacy tonight. We just have a few tips that I'd like to share with you. One is that all lines are muted. Please do not unmute them. We're asking that you place all of your questions into the monitored chat. We will monitor it the entire time during the presentation, and we'll pause the presenter, Reggie Joe, and ask your questions, and he will answer them. We'd also like to ask you or invite you to answer some of our poll questions during the presentation. There will be a couple of questions. We'll put them into the chat if you could answer them and just stay interactive with us tonight. Lastly, I appreciate all of you putting your cameras in place so that we can see your beautiful faces. And please add your email address to the chat if you would like to be contacted by the presenter for more information. So thank you very much and enjoy.
Thank you again, everyone, for joining our first of a 4-part virtual financial literacy series for our Building Your Economic Legacy target. Tonight, we are joined by Reggie Joe as our featured speaker for tonight. Reggie was raised in Wilmington, North Carolina, and graduated from Elizabeth City State University with his Bachelor's of Science in Accounting. He currently resides in Raleigh with his wife and has 3 sons. A small business owner since the age of 26, and in the financial service industry for the past 13 years, Reggie practiced specializing in working primarily with women. He currently holds the industry top designations, including Certified Financial Planner, Chartered Life Underwriter, and Chartered Financial Consultant, and Retirement Income Certified Professional. Reggie is a founding charter member of the Wake Forest Roseville Alumni Chapter of Kappa Alpha Psi Fraternity. In his free time, he enjoys playing golf and attending his son's track meets. And I apologize, I just got into the introduction and forgot to introduce myself. My name is Lashara Owens, and I am the co-chair with Sorashima for the Building Your Economic Legacy Committee within the chapter of Omega Lambda Omega. Thank you again for joining, and we'll turn it over to Reggie.
All right, you guys with me on my screen? Nod heads, everybody with me?
Not yet. We can see you, not your screen.
Can't see my screen yet?
Not yet.
Here we're good?
Yep, thank you.
All right, good deal. All right, I want to thank you all for having me. Almost like we've got this good relationship. I've done several presentations for you all, and as well as your regional meetings. So we're gonna be right at home. The one thing I want to say before we jump in, we're going to jump jump all the way in here. I want you guys to get as much out of this as possible. So it's going to be important for you all to ask whatever questions, I mean, whatever comes to mind. It doesn't matter. Let's touch on it. I'm going to go through the presentation, but it's just going to be a guide. We do not have to stick with every little piece, although there are 5 topics in here I'm going to touch on. But along the way, feel free to ask whatever questions, stick them in the chat box, and let's see if you can get as much as possible out of the presentation. But we're going to focus on how to build financial security from a high level, a bird's eye view, touching on a variety of different things. So the first thing is having a plan. It's very, very, very important to have a plan when you look at planning for anything. I mean, you look at this meeting, you guys didn't just pop up today in the last 30 minutes and get online. You plan, you scheduled it, you planned it. So you have to plan for whatever goes, whether it's purchasing a house, whether it's retirement. So the question is, do you have a plan to reach your goals? And that should be several different plans, because every goal needs a different plan. And along those lines, how confident are you that you will meet your goals? You know, we can have a plan. You can have a plan to purchase a house next year, this time, but how confident are you in your plan, or are you just sort of winging it? That's with anything. You have to have a plan along the way. So we're going to talk about every part of having a plan and what goes into it. So we're gonna jump over here. So write your ideas, your goals, your thoughts, and your processes down. So this is a worksheet that I typically use with clients to start off actually writing down all the goals for the future. So write your goals down. You don't know what you're going to do, how you're going to get there if you don't write it down. There's a lot of power in putting things to paper. Here are 5 key actions that we're gonna touch on today. One is saving dollars, how to save, where to save, so on and so forth. And we're gonna talk about spending money too. You can't save everything and not spend anything. We have to spend money, but we're gonna talk about how to be efficient with spending money. And then how do we grow our money? How do we grow our money? A lot of people talk about building wealth, so on and so forth. However, they want to keep their dollars in a savings account that's not growing. So how do we grow our money? And then after that, how do we protect our money? How do we protect the dollars that we work so hard to save and grow? And then in the end, which we'll go into legacy planning, so on and so forth, that you guys will have the pleasure of having a different session for, how do we give the money that we want to give and plan to give? How do we give that money away efficiently and do so from a tax standpoint and give what we want to give? So these are the 5 things we're going to touch on today. But again, along the way, if you have questions, feel free to hit the chat box and ask whatever questions. So what are you saving for? What are some of the things that you're saving for? Is it retirement? I hope everybody's planning for retirement in some form or fashion. Kids' education, a new car, a boat, a second home. Again, write down and know what you're saving for. A lot of people, they're saving dollars and it's like, well, I don't know what it's for. Every penny you have should be earmarked for something. There's no extra money. If I were to hit the lottery and win $1 million today, I've got that money earmarked for something. There's no extra money, like we like to say. So think about your goals. Think about your goals. All of your goals are different. The time span is different. How you save for those goals are different. So how you approach your goals are going to be different. For example, short term, what's something that you may want to purchase in the next 6 to 12 months? Where are you saving that money? That shouldn't be in your retirement account. It shouldn't be in an investment account because it's short term. So those dollars should be liquid. In other words, you should really get your hands on it without penalty or risk of loss of the funds. Then we have what's called, what I like to call your midterm dollars. Dollars you may not need for the next 5 or 10 years. What's something you may need funds for in 5 to 10 years? Where are you putting that money? Where are you saving that money? And then you have your long-term goals. Those are your retirement goals, so on and so forth, 10+ years. You guys will hear me talk a lot about buckets. Each bucket should have a different objective and time horizon and savings philosophy behind it. Your short-term dollars should not be in the same bucket as your long-term dollars. What I mean by that, a lot of people will, what I find oftentimes is they'll have a checking account, maybe a savings account with a few dollars in it, and then a 401k or 403b, depending on where you're employed. And what they tend to do is use their 401k or 403b as their go-to bucket. Because think about it, when you first signed up for a 401k, whenever that was, what was one of the things that they talked about? You can borrow from your 401k, right? And it sounds attractive. I get to pay myself back. That's a good place to save money and to pull money from. It is not. It is not a good place to pull money from for your kids' education or your down payment on your home, although people do it all the time because they haven't saved in these other buckets. You have to have these other buckets to prepare and plan for the things that are going to pop up. So let me say it again. You have the option to borrow from your 401k. That should not be your go-to. You should have some short-term dollars and some midterm dollars that are liquid. Now that's important, the liquidity. The liquidity, so where does that money go where I can still get my hands on it without a penalty? And that could be just in a brokerage account. That could be a short-term CD. It could be a money market account. So don't use your long-term dollars for short-term goals. We good there? Let me stop for a minute. Any questions on that? Seems anything in the... All right.
I'm sorry, Reggie Joe, there is a question.
Okay.
Alexia has a 401k, a money market, and 2 savings accounts. Do you think she should also get a CD?
That's actually a great question. Given our current interest rates and where the markets are now, CDs are great and it has its place, but I wouldn't recommend it right now because you're not earning anything on it. You're tying your dollars up and you're not earning anything on it. So I really wouldn't recommend a CD right now, just because of where we are. Everybody knows, money's cheap right now. You're not getting anything on our short-term instruments. So not right now. Now, another option, if it's midterm dollars, we're talking about midterm dollars you don't need right now, but you don't want to put it in a retirement account, you can just do an investment account. And that's just a basic investment account, a brokerage account, where it's invested and you can be as aggressive or conservative as you want to be to get some return on the dollars and not have it sitting in savings where you're definitely not earning anything. So specifically, I wouldn't suggest a CD right now, although CDs have their places. I just wouldn't recommend it right now, given our current interest rates. That's actually a good question. All right, if there's anything else, let's move on. So here's a big question that a lot of people struggle with and have, is how much money you should save and where you should save it, so on and so forth. So this is I'm really not a big fan of these general rules because everybody's situation is different. However, it is a good guide if you don't know where to go. majority of your dollars should go toward your fixed expenses, your essential needs, your mortgage, your rent, your car note, so on and so forth, your things we need to live on. But look at the 20%, and I want to push back on that a little bit. Saving and investing, if we're talking retirement, 20% should be the minimum of your retirement savings. Now, that doesn't mean it all has to be in the same place. So I'm not saying you need to put 20% in your 401k or 403b, but your retirement buckets should be 20%. And as we get older, and the later we start, that number needs to be a little high. That percentage needs to be a little higher because you're starting a little later. There are some fundamental things that we've all heard time and time again. Start early. Compound interest is a wonderful thing. The sooner, the better. However, it's never too late. But what I often see is someone will start a job and their company is matching, if we're lucky, the company's matching maybe 6%. That's the common number with a lot of companies. And when I see people will put in up to get the match, to get the free money. At minimum, you have to do that. Minimum, you have to get the free money. It just doesn't make sense to leave money on the table. Even if your company does not match, you still need to save in your retirement account. You still need to save. So let's be clear. If there's no match, you still need to do your part. The match is just gravy. However, I'm gonna just use round numbers. If you're making $100,000 and then you're putting 6% of your 401k, you're underfunded for retirement. I mean, you're already underfunded because 6% is not enough. And you can give some pushback and say, well, you know what? They're matching 6%, so technically I have 12% going into my retirement account. You're absolutely right, but guess what? You're still underfunded. It's not enough. It's not enough. I've done this enough. The numbers just don't add up. The only way that works, if you're putting in 10 or 12% of your 401k, is if you start off at 25 years old, your first job, and you start saving and live below your means. You can get there. But if most of you are like me, you didn't really start making, you didn't have a real job at 25. Some of us did, but I didn't. And things happen along the way. You may be unemployed for a while. You may sit out of work. If it's a woman, you have a baby, you may sit out of work for a while. Things happen. A lot of times women, not to ignore any of the men on the call, but a lot of times women will leave the workplace to take care of loved ones. So you have to save dollars, and 10 or 15% is just not enough. So it really should be around 20 or 30% of your income toward your retirement goals. And that doesn't include the discretionary dollars, so on and so forth. So if you're doing just the match, I can guarantee you if I were to sit down and run a retirement analysis for you, you're under retirement. You're underfunded for retirement. So how much money you should put away? Minimum 20%. Minimum. And you don't do this overnight. So I'm not saying, hey, you should be doing 20% tomorrow, go and change your 401k, because it just doesn't happen that way. But just do it gradually. And ways to do that, if you get a raise, you get a bonus, put that money in your retirement account. If you get a 3% raise, bump up your 401k account 3%. You hadn't been used to the money, so why add it now? Every year, just increase it a little bit. So just, over 2, 3 years, 4 years, you'll have it up a little higher. So just look at how much you're saving and try and bump that up. Because I often see that people think they're content and say, well, I'm doing the match, that's enough. It's not enough. It's not enough. So back a couple pages, talk about these dollars. They're, again, buckets. Different buckets is what you need. You need your short-term dollars, midterm dollars, long-term, and retirement. So when I talk about these different buckets, these are examples of different accounts. So let me stop for a second and kind of go through taxable. Now, what I mean by that is these are dollars where you're going to be taxed annually. So your checking account, Typically at the end of the year, you'll get the little 1099 from your bank or whatever, you file it on your taxes. If there's an investment account, capital gains, you pay those taxes annually versus tax deferred. I'm gonna jump over the long-term cash value life insurance and go to the mix of tax deferred and taxable. So 401k, traditional IRA, Roth, and annuities. So your 401k and all these accounts is just about the taxes and how the money's taxed. The 401k and IRAs, you get a tax deduction going in. In other words, you're not taxed on the money now. You get tax deferred growth. They're deferring the taxes on it. However, when you pull that money out, you're going to be taxed when you pull that money out down the road. Now, the Roth is just the opposite. You already pay the taxes on the money. You put it in the account. The dollars grow tax-free because you've already paid the taxes on it. So with the Roth, you don't have to pay taxes on the dollars later on down the road. So it's not a either or, it's an and, if that makes sense. So it's not, do I do a Roth or do I do a traditional? You should do both. We don't know what our tax situation is going to be in the future. We don't know what our situation is going to be. So you want to position yourself, the more of these buckets and different types of accounts, the better you're positioned for the future. So the Roth may come into play if you're trying to keep your taxable income down. You can pull more dollars from the Roth. Your 401k, you're going to be taxed on those dollars. And if you save for retirement, you should have some of these accounts. You have to use your retirement account to get tax deferral growth. An annuity just depends on the type of annuity. Let me back up for a second. Shima, I'm gonna put this in the poll and I'll see what kind of responses we get. What is an annuity? So here's one of the poll questions I'm gonna kind of throw in the mix. What is an annuity? That's for everybody. What's an annuity? Anybody responding, Shima? You guys got to wake up in here now. We're not doing this today. We're gonna wake up.
That's a test question. We don't know. Let me see. I don't see any answers yet.
All right. Okay, good. All an annuity is, there are different types of annuities, but let's just cut through all the noise. An annuity is a guaranteed income stream that you cannot outlive. For example, Social Security is an annuity. That's all it is. If you're fortunate enough to have a pension, or if you work for the state, you have state retirement, that is an annuity. So when you start drawing that income, it's an income stream that you cannot outlive. You can't run out of an annuity. That's all it is. And there's a non-qualified and a qualified annuity. A non-qualified annuity is one that you put dollars in after tax. It grows tax deferred. However, when you pull money out of that account, it's going to be a percentage of your gains coming out and your contributions. So part of it will be taxed, part of it will not be taxed. If it's a qualified annuity, meaning it's part of a retirement plan, or you use retirement dollars to go into the annuity, then all of it will be taxed when you pull it out. So it just depends on if it's non-qualified or qualified annuity. I think everybody should own an annuity. One of the biggest fears of people in retirement is running out of money. That is the one way to guarantee that you will not run out of money, is to have some sort of an annuity. My suggestion would be in addition to Social Security. If you have a state retirement plan or you have a pension plan, then you may not need an annuity because you have a couple already. So it really depends on your career situation and what you've had access to all the time. A lot of companies are going away from pension plans. And trust me, you can have $2 million at retirement in a 401k or IRA and potentially run out of money. You can't run out of money with an annuity. So a portion of your dollars should be what we call annuitized. So let's jump back to the cash value life insurance. That's a vehicle that, for whatever reason, a lot of people just aren't aware of how this vehicle is used. It is life insurance. However, it's a good vehicle to grow dollars tax deferred, where you're growing dollars that are safe. You can't lose your value. It's not tied to the market. And you can pull the dollars out tax-free depending on how you take the dollars out. And some of it can be taxed. But that's a huge vehicle that a lot of people just aren't aware of, or just choose not to look at because of the premiums. But that's a huge asset. And think about it a lot like owning your house. Why do you own a house? That's a different conversation. However, these are the different types of accounts that you need to have what we call a diversified portfolio across the board.
Reggie, we
Yes.
have one question
Okay.
from Shantae, I think, or Shanti.
Yes, it's Shantae.
Shantae.
Okay.
Currently, Social Security is in jeopardy and pensions are not always available. What other options are there for annuities?
That is a great question. That's a great question. You can purchase an annuity outside. I mean, you can go to insurance companies offer annuities. You can purchase an annuity through an insurance company. However, you don't want to use majority of your dollars to do so. I always look at no more than a third going into annuitize, because you don't want to tie up all of your money. Because what you're doing, in essence, let's just say you have a $300,000 IRA. You can take $100,000 of that. What you're doing is giving that to the insurance company, and they're guaranteeing you an income stream at some point down the road when you choose to. So you don't have access to that cash anymore. So if you run through the other 200,000, you can't go and say, well, I need another 25,000 from, nope, you can't. That money, you can't get it. But they're going to guarantee that you will get a check every month. So you're trading your dollars, you're buying this income stream. Back to the Social Security though. A lot of people are curious about Social Security. Social Security, I don't have a crystal ball, but Social Security will not go away, in my opinion. There are too many people that are dependent on Social Security. As of right now, Social Security is funded at 100% up to 2033, up to 75% up to 2075, I think, or somewhere in there. And they haven't made any changes recently to the Social Security plan. Social Security will not go away. They have to make some adjustments, and they will. But if you pull your Social Security statement, it will say on the statement how they're funded and how long they're funded. So don't worry about it. Social Security won't go away. There's a lot of people who have that fear. It won't go away. It has to be changed, overhauled. For example, they've been doing it slowly over the years. For example, full Social Security was 65 for some, it's 66 for some, now it's 67 for some, depending on the age when you were born. So they're making changes, and they're going to probably continue to extend that. So rest assured, Social Security will be around. And do not, well, depending on your family history and circumstances, do not just automatically assume you're going to take Social Security at 62. That is a mistake for most people. And I understand tomorrow's not promised, but what if it is? Because really, if you and I encourage you guys to go out to Social Security system, order your Social Security statement, and look at the number of income that you receive at 62 and at 70. It's between 62 and 70 for most people. That number doubles. That number doubles. And it's about 50% more at 67, 68, depending on when you get the full retirement. So don't just automatically go with, I've been working all my life, I might not get it back. This is a time when you need to work with a planner and really think about whether it's a good idea to take Social Security at 62. I see so many people make that mistake and regret it later. Because think about it, if you take it 62 and you live to 80, you've shortened yourself. because you're gonna need dollars down the road. You've got health issues. I mean, it is what it is. You're not working anymore. You may have run out of your 401k. So just keep that in mind. Speaking of 401k, so here's the options. A lot of people don't know they have options when they leave their current job. So you have three options. One is you can leave your 401k with your employer. If it's below a certain amount, typically around 5,000, they're going to make you move it because they don't want to keep it. But if it's over that, typically you can leave your 401k with your employer and move on. Secondly, you can roll over into your new employer. I always recommend always take your money with you where you have some control over it. Some people like to leave it their employer, but what ends up happening is they may change jobs 3 or 4 or 5 times and have all these 401ks around. Nobody's managing them, nobody's looking at them, and they forget about half of them. But you can either leave it there, one, roll it over into your current 401k plan, or roll over to an IRA, individual retirement account. The third is typically my recommendation, unless you have a plan that's just knocking it out the park and is really performing well. I'd recommend moving them to an IRA and have somebody manage those dollars for you. And what I mean by that, for example, we have a lot of volatility in the marketplace. What I often see is somebody will sign up for a 401k and they'll pick their allocation, or they'll let the company pick it for them, and they leave it. And then they find out later on their risk tolerance is either aggressive or conservative, and they were in just the opposite. So you have 3 options to your 401k: to leave it, move it into your new plan, or move it over into an IRA. By all means, do not cash out your 401k. For the younger folks, that's typically what happens. You change jobs. Well, I only had 3,000 and I'll just cash it out. Do not do that. You will get a penalty if you do that, and you have to pay the taxes on it. That's a costly cash out. It's not worth it. And I guarantee you, for those of us that are a little bit older, we know you will regret it later on down the road. Do not cash out those 401k plans. Now, don't get me wrong. If you need the money for something, do what you have to do. Let's be clear. Same thing with Social Security. If you're 62 and you just haven't saved enough, and if for whatever reason you need the money, do what you have to do. But don't cash out these 401k plans. We've got COVID going on right now. A lot of people are having some change in their jobs. Anybody that works with me will tell you I'm a big advocate of never, ever, ever touching your retirement account. However, as of right now, because of COVID and the CARES Act, if you need to pull money from your 401k or IRA, you can do so without a penalty in 2020. That's not to encourage you to do it. I almost hesitate to even share that information, but you can actually access your dollars in your 401k IRA plan in 2020 because of the CARES Act and everything that's going on with COVID. But I still stand with, do not touch your retirement accounts.
Hi, Reggie, we have a question from Facebook.
Sure.
The question is from Kenya. Last year, when my daughter graduated high school, she was told that if she invests $1,000, her money would grow to over $500,000 by the time she retired. Where should she put this money? In a Roth, IRA, or CD?
That's a tough question. I don't know if I can really answer it without having more information. And the reason I say that is because it really will depend on, one, how it's allocated. Is it aggressive or is it conservative? That's going to determine the return. If it's conservative, it may not reach that goal. You know what I mean? If it's aggressive, it may be more than that. You know what I mean? So I really can't say that. But what I will say is, do it. Invest it somewhere. Put it somewhere. And if
She's in college now. So if she had $1,000 that say she got for graduation money and she's in college now, would you recommend she do a CD, IRA, or Roth right now at 19 years old?
Well, the Roth and the IRA are going to be excluded because
Right.
that has to come from earned income.
Mm-hmm.
CD is really not gaining anything, but that doesn't mean she can't put it into an investment account, just an investment account. So
Okay.
with the limited information I'm provided, that's what I would go for several reasons. One, that's really the only option she has if she wants to get some growth on it. And two, being that young, she's probably going to use some of that money coming up for something. I mean, she's going to buy a house or buy a car. She's going to need some of that money for something. So some of it needs to be liquid. However, yes, some of it should be invested, and if she wants to do that, brokerage account would probably be the best way to go with the limited information I had.
Okay.
So hopefully that answer. But the Roth and the retirement accounts are excluded because it has to be from earned income.
Okay. Thank you.
Reggie, we've got 2 more questions in the chat. The first one was a little while ago, just about the annuities and what was the rate or percentage of return on an annuity was the first one.
So there are different types of annuities. It depends on the type you have. It could be a variable where you have investment options, or it could be a fixed annuity with the fixed rate, and that would depend on the insurance company. It depends on the product. There are different types of annuities. So it depends on the product. So really, I can't answer that question because it really depends on the product that you go with.
And the second question is about investments from LaQuanche. What are some different types of investment accounts?
I assume it's accounts, which is exactly what we were looking at. Let me go back a few pages. So a brokerage account is kind of hard to explain. It's just an investment. Just think about a 401k that doesn't have the tax implications. You've got post-tax dollars, you still got investments, and typically you have mutual funds in those accounts. I mean, you have mutual funds in your 401k and your IRAs, but you have mutual funds in just a straight investment account, but the dollars are liquid. It's all about the taxes. The difference in these accounts are taxes. This is not a pre-tax account. You don't get a tax deduction for it. It doesn't have tax deferred growth. Again, you're taxed on your gains annually, but you can touch the money without a penalty. So I don't know if that question is about the type of accounts or the type of funds in the accounts. That's a different conversation.
I think it was about the accounts because you said if we did take our money out of the 401k to invest it, put it in an investment account, I think that was when it came.
Gotcha. Yeah. So and really, this is the account I see most people missing in their plan, because people have a checking and savings and then they have their retirement account. There's no in between account. This is the one that most people miss, that liquid account for the midterm dollars, the liquidity. So that's why they end up going to the 401k. They don't have that bucket. And that's an important, extremely important bucket, because we're going to spend money, just like the young lady, the 19-year-old, she's going to spend some money somewhere. So all of her money doesn't need to be tied up where she can't get to it. And same thing for us. Is there anything else any more questions before I move forward? Okay, cool. All right, so let's talk about spending some money. See how people get excited with spending? All right, so a budget. You have to know you have to know how much money you have coming in and how much you have going out. So here's my philosophy. Here's where I differ with the budget. I believe in a budget. I think you should know your fixed expenses, but I personally do not believe in living by a budget, if that makes sense. Because really, think about it. If we were in normal times, we'd be taking some trips every now and then, going to the beach. We'd be still going out having drinks, having dinner. So it's hard to dictate how much you're going to spend in gas this month. I mean, you can do an average and come up with an idea of, okay, on average, this is what I spend. Here's my philosophy, and I'm going to move on. My philosophy is, if you are saving what you need to save off the top, then you can spend what's left. But you have to do that first part first. So if you're saving 20, 25% into your retirement account, you're saving some more dollars in that midterm account, you have an emergency fund, then you can spend what's available. That's what people do. That's what we do. We spend what's available. There's a lot of you right now, if I gave you $1,000 extra in your cash flow, you're going to spend it. If I gave you $250, you're going to spend it just because it's available. So if you save first, then everything else is okay, and you can spend, how you want. Because most people can't just sit on cash. Most people are spenders. So if you're in that spender category, you're in the majority. Most people are spenders. But really, if you're carving dollars off the top and putting it towards your goals, then you can spend what's left. That's just my philosophy on budgeting. Now, you need to know what your fixed expenses. You need to know, okay, I've got $2,500 going out a month, or $5,000 or $10,000 or whatever it is. But if you save first, then you don't have to. Typically, when people overspend, then they want to tighten down to see where's all my money going, because they're overspending first and then trying to save.
All right. We'll take the tip to save first. I got a question coming in.
Sure.
Actually, Jasmine said, I have a problem. Money burns my pockets. But the question is from Lakaja. What do you think about a stable 401k account, and when your employer does not match your contributions?
So a stable, I assume you're talking about the fund that's in there, a stable fund. And if that's the case, that's the conservative fund. So here's the deal. You need to know what your risk tolerance is. In other words, how much risk are you willing to take to get a certain amount of return? For example, you've heard the phrase low risk, low return, high risk, high return. A stable fund is more conservative. What was the second part of that, Shima?
Second part was, what do you do when your employer does not match your contributions, your 401k?
You still contribute. I mean, you just have to contribute more because you just don't have the luxury of having some free money. So you still have to do your part, regardless of what they're doing. You still have to do your part. I mean, I often see that. You still have to save regardless if they're helping you out or not. All right, we're good there. All right, so let's talk about freeing up some money and managing debt. The good old credit card. The good old credit card. So credit cards is probably the biggest monkey on everybody's back when you talk about debt. Aside from student loan, which we can argue that can be good debt. Depending. Now, if you decided to go to be a career student and go and get 2 or 3 PhDs, then, that's a different conversation. However, credit cards typically have the highest interest rates of any debt that we'll have. If you can get rid of these credit cards, get rid of the credit cards, because that is what is killing you. And you can't pay off credit cards if you're still using them. So at some point, if you're living off of credit cards and you haven't had some type of event like a layoff or an emergency or something, if you're living off credit cards, you're living above your means. It is what it is. And you need to stop living above your means, get under control, or you will always be on this cycle. Credit cards minimum, typically a credit union is what, 8% or so. That's a high interest rate today. So here's a tip: if you have multiple credit cards and you really want to pay the debt off, attack the highest interest rate first. It's just math. Don't get caught up with the instant gratification in the smallest one. Just think about it this way: if you have a $10,000 credit card, and then you have one that's $2,000, the $10,000 has a 20% interest rate, the 2,000 has a 10% interest rate. Typically, human nature is like, let me pay off this smaller one because I can feel that sooner. But that 10% interest rate on the higher card is hurting you a whole lot more. I mean, the 20% is hurting you a whole lot more than the 10% on a smaller amount. It's math. It's just math. So pay the minimum on the smaller interest rate cards and dump everything on the higher interest rate, and you will pay it down faster. The numbers are what they are. So don't get caught up with the instant gratification, which is easy. It feels good, but it doesn't help you financially. Once you pay off the credit cards, then you can start saving dollars. So just think about, so this is an exercise for everybody that has credit cards. Think about how much you're paying monthly. Do the math and see how much you're paying monthly on your credit cards, and imagine if you were saving that money monthly. Sheila, were you about to?
Yes, this question has actually been addressed in the chat, but I wanted everyone to hear you say it just in case they're not checking the chat. Alexia says, in 4 months, I will be credit card free. I started this year with about $13,000 in credit card debt. Should I close the cards after I pay it off? I only have 2 credit cards.
No, I'd say not to pay it off. One, you're going to need credit cards, and I mean, we need credit cards. You need to airlines, hotels. We need credit cards, but it can actually affect your credit if you close credit cards. So just don't use it. Now, if it's just one, that may not hurt you at all, but typically people will pay down debt and cancel 5 credit cards at one time, and that actually hurts. But if you only have 2 credit cards, I wouldn't pay them off. I'd keep, because you want to have that line of credit for emergency anyway. But congratulations on paying that off.
Go on and pay it down, but don't close it.
Right, exactly.
And then we've got another one from Nicole Jones, who says she's very disciplined with her credit cards. She only has 1 card that she truly uses, and she pays it off at the end of each month. Her question is, how many credit cards should she hold on to? She knows it's not good to close them. But what's a good number of credit cards to have?
That's actually a great question. Let's put it this way. I have 2 credit cards. Because really, if you have a Visa and a Discovery, or a Visa and American Express, you can pretty much use those anywhere. Or where you can't use one, you can use the other. But where people get into trouble is the Target, the Sam's, all these department store credit cards to get the 10% off or 20% off, but then you carry a balance and give them the money right back. You don't need all these department store cards. You don't. That will cause more harm in the long run, and it's not worth the discount you're going to get on this one particular sale. So I'd say 2 major credit cards. That's just my personal take on that.
One more, maybe they're coming in, so give me a second.
Okay,
the interest rate, about the interest rate. I'm sorry, not interest rate. What percentage of the credit limit should be used?
That's actually a great question. And the thing about, and I assume you're trying to, you're factoring in how to affect your score. The thing I hate about the credit bureaus, nobody knows every bureau has a different system. So we don't know what goes in that formula. So, I mean, I can't give you an answer. Well, I can give you an answer. And the answer is don't carry credit. If you use the cards, pay it off. Then you don't have to worry about it.
Good suggestion. One more. Other than credit cards. So Eileen Badger says, I don't own any credit cards, but student loans debt free seems like a dream. I've been suggested to get a credit card to establish credit, but what are other ways to establish credit?
So credit cards, of course, is one. If you have a car note, that helps establish credit. If you have a mortgage, that helps to establish credit. I don't know where she is in her process, but the credit card is one of different types of credit. And that's the thing, you need different types of credit, a revolving debt, and then, you know, an installment debt. So all of that is different. You get different points for different types of credit. So outside of a car note or a mortgage, you know, I'm drawing a blank here. Those are the main ones that, and a credit card that helps establish credit. And if it's somebody that, I don't know, if it's somebody that's young to ask that question, actually, if you have a parent that's willing to put you on one of their cards, that will help you establish credit as well. And that they can actually put you on their card and it'll apply to you as well to help your credit.
Assuming your parent has good credit.
Assuming your parent has good credit and is willing to put you on one of their cards. So it's twofold. All right, I'm not going to spend a lot of time here. If you all have student loans, first of all, if you're in some type of loan forgiveness, utilize that. If you have kids and you can guide them into loan forgiveness, utilize that, because that's a great way to, anytime you can be forgiven on debt, you've won. But also do an audit on your student loans and see if you need to consolidate, because rates are low now. There's a company that I work with that does a good job of helping people consolidate. So if some of you have multiple student loans, you want to look at your rate, reach out to me and I can kind of connect you. But rates are low now. You can get lower interest rates on a lot of these loans, potentially, depending on where you are. And all of this helps to free up money. When you can get a lower interest rate, that's going to free up some dollars for you there. All right, again.
Before you go to the next slide, there's a question about consolidation. Do you recommend credit repair agencies that consolidate your credit and allow you to pay it off at a lower rate, like student loans, credit cards, and miscellaneous, putting all that together, consolidating and going through the agency so you can pay one amount?
I'm a little leery of a lot of these credit repair agencies. A lot of stuff you can do yourself if you take the time. I don't know your situation, but look at different types of loans and with your banks and so on and so forth. So we're talking to a couple different things. One, credit repair, which always raises the hair on the back of my neck when I hear a credit repair agency. And then you're talking about loan consolidation. Those are two different things. So I'd find somebody, a lender somewhere, a banker, and sit down and talk to somebody and see what your options are. I'm just leery when I hear people say credit repair agencies, because there's a lot of companies out here say they do that, but they really don't, and they're just kind of collecting this monthly fee. It sounds good, and they kind of prey on that, to be honest with you, but I'm a little leery about that. I'm not saying not. Just do your homework, check the company out, see if they're legit, and just kind of go from there, make a decision from there.
Two more questions. Nicole Jones asked if you can tell us what a low student loan rate is. Under 5%, under 3%, what's a low student loan rate?
Definitely anything under 5%. So of course, your credit score factors in on that. But if you're over 5%, based on some of the things I've seen, you can probably get a lower rate. And if someone has a mortgage, I mean, that depend on your interest rate and depend on the equity in your home. I mean, be creative. It may make sense to refinance your mortgage and pay off the student loan. So there are different options out there that you can look at. But again, if you have questions on that, just shoot me an email and I don't handle that, but there's a company that I work with closely, and they've done a lot of good work with some of my clients. I've had good feedback from that, so it doesn't cost you anything to look at it. So I can definitely connect you.
And then again, we've got your assistant, Miss Joe, Nicola Watson Joe, is answering some questions for us in.
There you go for the mortgages. There you go. She can help you.
Answering questions in the chat, but I just like for you to repeat the answer so everybody can hear it. That the question was asked, do medical bills hurt your credit score? And Nicola did answer, yes, medical bills can hurt your FICO.
I'm glad she answered that question. All right, anything else in there? Did I get everything? Okay, cool. Mortgage debt. And again, Nicola's, she's working real hard, spent a lot of time on the couch, doing a lot of refis. Rates are low now, rates are changing. So definitely look at refinancing if you can, and use some of those dollars to pay off some of this debt. One thing I will say about that though, if you do consolidate in some form or fashion, if it's a refi, just a consolidation, do not go back and run the debt up. So ask yourself, how did I get this debt? Because that's what a lot of people do, and they compound the problem. They're going to clean slate and then go back to the same habits. You can't do it. You're going to put yourself in a worse position to do that. Mortgage. So with your mortgage, here's my take on paying your mortgage down. One, if you have all this other debt, don't even consider paying your mortgage down, because you probably have a lower interest rate on your mortgage anyway. It's just a matter of how low you can get it. But if you have credit cards, student loans, focus on that, not paying extra on the mortgage. With the mortgage, and if you guys have a mortgage, you probably have gotten a letter or something somewhere that says, hey, you can set up your biweekly payment to get the one extra payment in, which is fine. And that will help pay your mortgage down. However, that's a third-party company. Understand what's going on. That's a third-party company that's doing that for you, and they're making that payment twice a year, which means 6 months in between, they're holding your money, earning interest off your money. So if you're going to make extra payments, make principal payments yourself, or add it into your mortgage, where you have, if your mortgage is $1,500, pay $2,000 a month and let that $500 go towards your principal payment. You will pay it off a lot faster than using this third-party vendor to do it biweekly. If you want to pay it biweekly, do it yourself. Now everybody can do bill pay. Do it yourself. So just make that extra payment, and it will help pay your mortgage off faster. Now, my philosophy, Nicole may give me pushback here. You can do a 15-year mortgage. She can correct me if I'm wrong, maybe a 10-year mortgage, 30-year mortgage. My philosophy is always get the longest term, the 30-year mortgage that's available, and make extra payments. That way, if you run into cash flow issues, you can stop the extra payments. Like if you're making a $2,000 payment every month, but your mortgage payment is only $500, you run into cash flow issues, you can stop that $500 and just make the $1,500 payment. You gotta look, I'm coming from a planning perspective, and I'm always gonna err on the side of caution and give yourself some wiggle room if life gets in the way. Let's put it that way. If life gets in the way temporarily, give yourself an out and not be stuck to a $2,000 mortgage payment because you did a 50-year mortgage. All right, let's talk about growing our money. How do we grow our dollars? Again, investing goal, you have to know your risk tolerance. If the market takes a downturn and you lose, let's just say you have $100,000 in your IRA or 401k, and the market takes a downturn, now you have 85,000 because COVID hit, and this is pretty much what happened this year. You have 85,000 now. you're riding around 440 looking for the highest bridge to jump off of. That means you shouldn't be that aggressive. That means you need to go a little more conservative, but understand your return is going to be less. So don't look at your neighbor talking about, well, they earned, their 401k, we started at the same time, same amount, they've got 125 in their account, and you only have 90. Well, if you're not taking as much risk, you're not going to get as much return. So know what your risk tolerance and your time horizon is on your investing. I'm going to venture out and play this real quick, if I can. Let me know if it. Can you all hear that? You can't hear that.
No, not yet. There's typically a plug-in that you have to do.
So that's not
to
going to
make
work.
sure we can hear it.
Right. Now I got to stop it. So this is talking about asset allocation and being invested. I mean, unshare and come back.
While you're doing that, Reggie, let me read this question to you from
Sure.
Gordon Smith. Which is more a priority, saving or paying off your debt? There's a lot of confusion about where to start. And in her opinion, if you don't have a savings, you need to, at a minimum, quickly save at least $1,000, simply because if you have only contributed to your debt, when an emergency happens and you need money quickly, you'll just dig yourself into more debt, taking it from a line of credit. She does understand paying off debt as quickly as possible is essential, especially if you have an introductory rate of 0% for a limited time. It may be best to focus on paying your debt to avoid interest. So what are your thoughts of which should be the priority, saving money or paying off debt?
So it's actually going to be both. It's not an either or. It's an and. You need to try and do both. I mean, it really is a balancing act, because think about it. If compound interest is so huge and you have to grow your money and let it compound over time, and you have to get it started. However, you still have to contribute to your debt and pay your debt down. So it's not an either or. It really is a balancing act. It's an and. And I know that's the kind of a tough answer, but it is what it is. It's not an either or. You have to do a little bit of both.
There was one more question from Facebook. Oh, let me ask you this one first, from Felicia Lowry Herndon. Is risk based on age? Should you be more or less risky at 60? And then I have one more after that one.
That is actually an excellent question. Yeah, she gets a star for that one. So what do we hear? When you're younger, you should be more aggressive, right? That is totally not the case. Let's think about it. If you were 25 and somebody gave you $1 million, would you invest all of it aggressively? Of course not. However, here's the deal. If you're let's just say you're 60 years old, but you intend to work until 70, which a lot of us probably will. You know, people live longer, the more they're healthier, the exercise. So if you have a 10-year time horizon, that's still long term. So you may still be aggressive in your investments, even at 60. So let's take it a step further. Let's say you are, let's say you are 67 and you retire. You're done. back to the annuity. Let's say you start taking Social Security, you have a retirement pension, you don't have any debt, and you have enough income to cover all your living expenses. Really, you may not have a need to touch your 401k or your IRA. So you may want to continue to be aggressive at it to get as much return as possible until you need it. So really, it just depends. Everybody's different. Everybody's different. So you can't look at it and say, just because I'm older, I need to be less aggressive. That's not the case. So, and part of it is, when will you need your money? If you don't need the money, then why are you going conservative? Now, on the flip side of that, if you start to need your money, then you may want to at least have a portion of it conservative and keep some of it aggressive and still grow the money. So it depends on your risk tolerance. If you can tolerate the market, you understand the market always comes back, then you may keep a portion of it aggressive. Now, realistically, from a planning perspective, for example, like my retirees, they didn't panic at all in 2020 because fourth quarter of 2019, we carved out cash to have through 2020. And that way we still investing their other dollars. So they didn't panic. There was no need because we've got dollars sitting in cash to get them through 2020. And we're going to reevaluate that. As a matter of fact, we're going into doing those reviews now. So it just depends. Everybody's situation is different. It really just depends. You can't look at your neighbor and look at what they're doing. And definitely do not look at your parents, because most of your parents probably have a retirement pension somehow, some way. And if they're telling you, you know, you don't need to save as much, or you don't need to be as aggressive, you can't plan the way your parents did. Because if you don't have a pension, your planning is totally different. All right, we good?
One more question. It's about mutual funds and your, I think it was just
And from Facebook, and she just said it wasn't mentioned. So I didn't know if that's something you can quickly mention, or it's going to take a lot longer than a 2 or 3 minute spiel.
What was the question?
She just said her comment was just she didn't hear any mention of mutual funds.
Actually, I think I did mention that earlier, but so mutual funds, all mutual funds are, you know, we know about stocks. We all know about stocks. We all know about bonds. Mutual fund is a whole bunch of stocks based on a certain allocation and a whole bunch of bonds put together. So it's not individual stocks. It's a lot of stocks. And for example, if you look at your 401k statement, you have all these funds in there. Those are mutual funds. So what that does is having mutual funds spreads out the risk. So if you have, let's say for instance, an aggressive allocation, you probably have all large cap, but you probably have 20 to 40 to 50 stocks in there, but all may be aggressive. So mutual funds, think about it, it's just a mutual, it's just a lot of stocks and a lot of bonds put together in a portfolio versus individual stock, going out and buying SAS and buying IBM, where you have a lot of risk because you have one or two or three stocks. So mutual funds are a combination of a lot of stocks and a combination of a lot of bonds. So hopefully that answered that question.
Okay, thank you.
Okay, cool. All right, I'm looking at time. We're running short. I'm glad they asked these questions, which is what we wanted. All right, let's talk about protecting our income. I'm gonna kind of run through this, but I want to pause here for a second and spend a little time. Disability coverage. When we talk about everything we've been talking about at this point is the offensive side of financial planning, growing money, saving money, so on and so forth. Now we're talking about the risk management, the defensive side. So what happens is if you guys work at a typical company, typical employer, you probably have a disability plan. If you have a disability, we're talking long-term, not short-term. If you have a disability, in most cases, it lasts more than 90 days, you're going to get 60% of your income that's typically a benefit given to you by your employer. So imagine having a 40% pay cut. How does that change your picture? A lot of people can't take a 40% pay cut. Actually, it's more than that, because if you take that 40% discount then that's got to be taxed, because if your company's paying for it, that's a taxable benefit. So what we do is put supplemental coverage on top of your employer's plan to maximize your benefit, to get you as much protection as possible. Just think about it. If you had a cash machine in the corner of your house that you can go get money from any point in time, would you put insurance on it? So you're a cash machine. We go out and work. Our ability to earn income is our biggest asset. Everything else we talk about is out the window if we lose our income. Even if you're conservative and you live well below your means, if you have a disability and you can live off of 50 to 60% of your income, then you don't have anything going to a retirement. So if you don't have supplemental disability coverage, please reach out to me, and it does not cost a lot. It's typically less than 1% of your gross income. This is what I was just sharing. Group coverage typically covers about 60% of your income, and that's taxed. Life insurance. A few things. This can be a long conversation, but a few things. You should have life insurance outside of your employer. Most people will have coverage with their employer, and then they get to retirement, or they leave their job and go start a business or get laid out, whatever it may be, and realize I no longer have life insurance because it was tied to the employer. You should have life insurance outside of your employer. Then you have term insurance and whole life insurance. So term insurance is temporary. It's for a certain period of time. It's extremely important, but the premiums are typically lower. Whole life insurance is like owning a house. It's a permanent policy. The premiums are higher, but it builds cash value and has what we call the living benefits. If you're interested in leaving a legacy, life insurance is the best way to leave a legacy. If you want to leave $1 million to your kid or kids or whatever, that's the only way to guarantee that you will leave $1 million. Because you don't know, even if you had $1 million in your 401k account, you pass away, how much your kid's going to get? Roughly $700,000, because it's taxed. So we're talking legacy. A lot of people want to, come to me and say, hey, I want to create generational wealth. Well, what does that mean? The best way to do that is through life insurance. It's the only tax-free bucket of money that you can pass on. Well, that's not necessarily true. A Roth is a good vehicle for legacy, but you've got variables tied to the market. And please look at how much life insurance you really need. Think about, so the question I ask all my clients, what do you want your life insurance to do for you? What do you want to do for you? Because typically we will have life insurance, but not enough. $100,000 is not enough. Because if you have let's just say you have a 2-income household and both parties make 100,000 and they've got 200,000 each. That's not enough. If one of them dies, the other one is going to struggle. If there's still a mortgage, there's still debt, if there's still kids. If you have a kid that you're raising, you plan on paying for college tuition. 100,000 may be enough to pay for tuition, but what about their income for them to maintain? What's their lifestyle going to be for them? If you're taking care of a loved one, if you're taking care of a parent and you die prematurely, who's going to supplement the dollars that you were supplementing their income with? So you have to think about all this stuff. Student loans, let me address that. When you're doing your assessment of life insurance, if you have a student loan and it's only in your name, your student loan dies with you. They can't get it from anybody else. So you don't have to add that in that assessment. But if you have a Parent Plus loan and somebody else is on it, then yeah. So think about enough life insurance, and I've done this long enough, if you're taking care of a kid and or you've got a 2 household income or you have 2 household income and kids, it starts at $1 million. Now you may want to factor in what you have with your employer, but $1 million is not a lot of money. I see your face, Sheem. I see your face. Think about it. So let's do the math. Yeah, exactly. That's why I like to see the face. Think about it. Let's just say, let's use round numbers. Let's say John and Jane both make $100,000 a year. They're probably living off of most of that. And let's say, let's pick on John. John has $1 million in coverage. John and everybody's 45 years old. 20 years before retirement. John passes away. Now you've got $1 million. So let's just say of that, you're going to spend $100,000 a year taking care of kids, paying off mortgage, because now it's all on you. What does John do around the house? Does he cut the grass? So who's going to cut the grass now? Does he fix stuff? Who's going to fix stuff now? And let's flip it around. Let's just say John and Jane passes on. Who's going to help with homework? Who's going to cook? Who's going to... So this is the kind of conversation I have with a lot of my women. And as far as the women, you guys really need to have quite a bit of money on your spouses. If you're the primary breadwinner, think about it. If he dies, what does that mean for you financially? Just imagine taking his income out of the picture. That affects your retirement, your trips that your family trips. You're not going to move. People will say, well, I will downsize and get a smaller house. No, you won't. You just lost your spouse. You're not going to change. You're not going to disrupt everything else. So what's really going on? So we had a tendency to underinsure ourselves just in general. But look at the number. It's just math. We get caught up with, well, I don't want to leave so-and-so. Really? Really? But think about the kids. Or do you want your spouse to go back to work? I mean, all these things come into place. So you got to think about it and not be underinsured. But we have a tendency to be underinsured, and we have a tendency to always have our coverage with our employers, which is a mistake. I have so many people coming in later in life, they retire, it's like, oh my God, I need life insurance now. And now they've got health issues, they're uninsurable. And you have to buy these death policies, these burial policies, or, as you all know, everybody's passing around a GoFundMe.
So I have a question from the chat. Jasmine is really fortunate because although she has her own life insurance policy, her parents also have a policy on her. And she's asking, are all of these policies necessary, or are her parents just playing with her?
So I'd say yes. If your parents have a policy, it's probably a whole life policy. That's an asset. So let's just say hypothetically, you get to 65 and you feel like, you know what? I'm not leaving anybody anything. Forget it. By that time, you will probably be the owner of your policy. You could literally cash that policy in or use an income stream from to help you in retirement. And that comes back, a lot of it comes back tax-free. So it can be part of a retirement strategy. It's still an asset. And we're talking about whole life insurance. We're not talking about term insurance. Term insurance is an expense. And you should reevaluate your insurance over time. It's not just, I'm gonna buy it and put it in a drawer somewhere and forget about it, because your needs change. If you buy a bigger house, you may need a bigger life insurance policy. So yes, if it's whole life insurance, it is necessary. Because it's an asset. It's literally an asset. It builds cash value. You can pull money from it. And you can leave it on. It's legacy. If you want to leave an inheritance, that's the best way to do it.
And you said whole life, not term life.
Well, I'm not saying you don't need term. Most of my clients, including myself, have a combination of both. Because you have to, for example, the largest part of my coverage is term simply because I can't afford all of my coverage in whole life because the premiums are higher. However, the intent was when my youngest was theoretically out of college, the majority of my coverage would go away, because what I didn't want was something to happen to me prematurely and Nicola still raise his kids and get them through college, and we not have the money for it. So she would have been, so once they get past that point, then a lot of that coverage would go away because I had it to help pay for education, so on and so forth. So it really just depends on your need. It could be, you know, if me and my spouse just bought a house, or I bought a house, I wanted to stay in the family. Something happens to me prematurely, I want them to be able to pay off the mortgage and maintain that, whatever it may be. However, you're going to need insurance long-term. A whole life is an asset, and those that understand it understand the benefits. For example, if you're a high income earner and you're maxing out your 401k at 19.5, if you make $250 a year or $200,000 a year, that's not enough money to help you through retirement. So it's a good vehicle to also, if you have an insurance need, good vehicle to store cash and grow safe dollars. It's not correlated to the marketplace. So it has its place. Both have their places. It's not an either or. Again, it's an and in most situations. Long-term care. I think the majority of people on this call, if not all, are women. You all should definitely look at having long-term care of some amount. Theoretically, you're going to outlive the men. If we live long enough, we're going to need care at some point in time. It's like having a car. You keep it long enough, it's going to break down at some point. This is something people don't like to talk about, but you probably have had a grandparent or somebody that has needed care. Now, don't get me wrong. We will all receive care. The question is, where and how will we receive that care? Are we in a nursing home, or are we in our home? Long-term care is to keep you out of a nursing home and keep you in your home, and to not have the family try to provide care. It's more managing care, not providing care. And we don't, a lot of our families are spread out. It's not like it used to be when a lot of families stayed in their hometown. Most of us are from somewhere else, and we're not, families aren't as large. So think about that. And that's something, whenever you're, as a matter of fact, I think on the back of your Social Security statement, it says to have a plan for long-term care. So whenever you're getting it from the government, you need to pay attention. And the costs are steadily increasing. So I'm gonna leave that there. So again, how do we give our money away? How do we give? A lot of us, you know, you guys in the sorority, I'm in a fraternity. There are different ways to give back. So just think about the different ways, and a lot of our benefits really are kind of going away now. We don't get the tax deduction that we used to. So kind of don't let that be the reason you're giving dollars away, but think about it. All right, so again, save, spend, grow your money, protect your money, and give it away. And we're right at 8:28. I timed that pretty well. Questions in 2 minutes. Anything else in the chat box, Shima?
Nothing else in the chat box. Lasharo, is there anything else in Facebook?
There is not. There's nothing else in Facebook.
I'm
No.
going to put my email address in there.
Okay.
Yes.
Yes, someone just asked, could you share your contact information again? So yes.
Misconceptions. It does not cost you guys any money to have a plan done. If you want to find your plan done, we can do it, and it will not cost you a penny. And there are no obligations. Secondly, you don't have to have $1 million to do it. Anybody can do a plan. A lot of people tend to think they have to have a lot of money to meet with the planner and have a financial plan done. Not necessarily the case.
That's good advice.
And also, let me be clear, Financial advisors are a dime a dozen. If you sit down with somebody, even if it's me, if you're not comfortable, do not work with that person. If you're not comfortable, because this is something you have to trust and be honest and open and lay everything on the table if they're really going to help you. If you're not comfortable and something's off for whatever reason, go find another advisor. Find another advisor. Because somebody sits across from me and I feel like they're not being upfront, I'm going to suggest it anyway. But we're dime a dozen. You financial advisor, but just find somebody that really that you're comfortable, that you trust, and that have some credentials.
Thank you. So we don't have any more questions on Facebook or the chat. I want to thank you again on behalf of my co-chair Shima and myself. Thank you, Reggie, so much for working with us and presenting today and sharing your wealth of knowledge. Thank you to all the participants. His contact information is in the chat. Thank you for so much for joining tonight. And this is only part one of a virtual financial literacy series that Shima and I have been working on. The next one is November 10th, and that one is titled Debt Detox. During that one, we're going to tackle the money mindset. We're also going to look at the power and pain of debt, because there is good debt and there is also bad debt. And also budget bosses is what she has down as her 3 topics. On November 17th, we're going to have attorney Keith Shackelford, and he's going to discuss wills and estate planning. Because I think that's something we don't think about until we get older. And actually, we need to start thinking about that now. And our last one will be December. I think that one may be December 1st. Is November 29th? Okay. And that will be hosted by us. The speaker will be Chuck Jones, and it will be on home buying. So if you have any additional questions, please email us at omegalambdaomega@gmail.com, and we will respond back to you. You will visit our website, oloofaka.com, and these flyers will be available later in the week for you to register and join those Zoom calls. Any other comments, Shima? No? Again, thank you guys for joining, and have a wonderful night.
Thank you.
Yeah.
Good night.